The Indian rupee has slipped to around 96 rupees per US dollar, making it the weakest Asian currency in 2026.
The rupee falls to a new record low. It slipped past 95 against the US dollar for the first time.
Persistently high crude prices could push up transportation, manufacturing, and household costs across the economy in the coming months.
What if I told you that a hedge fund manager sitting in New York could make your milk, vegetables, and cooking oil more expensive in India? That sounds exaggerated, but that's exactly what happens when global funds pull billions out of India. The rupee slides, and because India imports 85% of its crude oil and millions of tons of food pulses, your daily cost of living shoots up. Let's look at the data. Over the last 4 years, the Indian rupee has significantly lost its value against the dollar. And every time it falls, the imported fuel becomes more expensive. Transportation becomes more expensive. Food becomes more expensive. In other words, your money buys a little less than it did before. And that's strange because everyone keeps calling India the world's fastest growing economy. So why is our currency continuously falling? And why do some of the world's biggest investors suddenly rush for the exit whenever the rupee starts depreciating? And how much further will the rupee fall before your monthly expense spin completely out of control? To understand what's really pushing the rupee down, we have to look at India's biggest and most critical dependency, crude oil.
Now, India has confirmed it is buying crude oil and LPG from Iran amid supply disruptions in West Asia. The Ministry of Petroleum and Natural Gas said Indian refiners have secured their crude requirements, including supplies from Iran.
India imports roughly 85% of its entire oil requirement just to keep factories running, trucks moving, and the economy growing. But here is the catch. Whether we buy oil from Middle East, Russia, or Africa, the final bill cannot be paid in Indian rupees. Most of India's oil imports still have to be settled in US dollars, which means Indian oil companies must constantly take massive amount of Indian rupees, rush to the foreign exchange market, and dump them to buy physical US dollars. To understand why this destroys the value of our currency, let's zoom in. Think of it like a household budget. India earns dollar by exporting things like IT services, textile, and medicines. But the money we make from these exports rarely covers the cost of our oil imports. The result is a persistent trade deficit. Let's look at the data. In FY 25-26, India's total imports were about $980 billion, while total exports were only $860 billion, creating a massive deficit of $120 billion. This constant demand for dollar, especially from oil imports, creates a relentless downward pressure on the value of rupee. Let's put a simple example on the table. Imagine global oil is trading at $80 a barrel and the exchange rate is also 80 rupees per dollar. At this price, a single barrel will cost us 6,400 rupees. Now imagine global tensions flare up. As a result, oil prices spike to $100 a barrel, while the exchange rate is still 80 rupees per dollar. Suddenly, the exact same barrel of oil instantly skyrockets to 8,000 rupees. And the worst part, we did not even import a single extra drop of oil. We are just paying drastically more for the exact same amount. This massive drain of cash is what eventually forces the exchange rate up, pushing it way past 80 rupees per dollar. But oil and trade deficits only explain why the rupee weakens slowly. They do not explain why it sometimes falls so suddenly. To understand that sudden panic, we need to look at a trade global investors use to profit from interest rate gaps across countries. It is called the carry trade. Right now, trillions of dollars are moving across the global financial system. This money belongs to massive institutional investors, things like pension funds, university endowment, and hedge funds. And this huge pool of capital is on a relentless 24-hour hunt for one thing: the highest possible return on investment. When a developing nation like India shows roaring economic growth, it acts like a giant magnet for this global cash. This money enters the country through a vehicle called FPI, or foreign portfolio investors. So, what do they actually buy? Unlike FDI or foreign direct investment, which is used to buy land or set up manufacturing plants, this money is used to buy Indian government bonds and shares on stock market. And that is the exact problem with this money. Because it is completely electronic, this money can leave the country at a click of a button. It has absolutely no loyalty to India's growth or national development. It is there for one single reason: to ride the wave of high returns. And to get that high rate of return, these investors rarely use their own money. Instead, many large hedge funds do far more aggressive. They borrow massive amount of money from countries where interest rates are historically very low, like the US or Japan, and instantly route that cash into India. Why? To capture the gap between the low interest they owe back home and the much higher interest rate they can earn on Indian government bonds and top stock market companies. As long as markets stay calm, the trade works perfectly as planned. Step 1. They borrow cheap money abroad. Step 2. They sell those US dollars in the foreign exchange market to buy Indian rupees. Step 3. They deploy those rupees into Indian bonds to sit back and collect interest. On paper, it looks almost risk-free. But there is a massive catch. This entire bet relies on the exchange rate staying perfectly stable. If the rupee loses value, these investors will find themselves in a very dangerous situation. Now, let's put actual number on that risk. Imagine a Wall Street investor borrows $1 million at a tiny 2% interest rate. He converts that $1 million into Indian rupees at a rate of 80 rupees per dollar. Now he has 8 crore rupees to play with. He used that cash to buy an Indian government bond that pays 4% interest. By the end of the year, his money grows, turning those 8 crore into 8 crore and 32 lakh rupees. Now, to pay back his original loan in New York, he has to convert his 8 crore 32 lakh rupees back into US dollars. When you divide it by 80, you will get $1,040,000. But remember, he owes the American bank $1 million plus 2% interest. That means he needs to pay back $1,020,000, leaving him with $20,000 in pure profit. But that's the perfect scenario, where the exchange rate stays stable at 80 rupees per dollar. Now imagine that after months of pressure from rising oil import bills and trade deficit, the rupee depreciates by 10%. The exchange rate slips from 80 to 88 rupees per dollar. Now, to pay back his debt, he has to convert his cash at a new collapsed rate of 88 rupees. When he runs the math, he gets back about $945,000. But he still needs to pay back $1,020,000. Instead of walking away with a clean profit, he is hit with a deficit of 74,000 US dollars. A simple 10% drop in rupee did not just wipe out his profit, it completely ate into his core investment. So the question is, do these investors just sit around and accept those losses? Of course not, because the moment these institutional investors realize the rupee is going to dip, they do not wait. To protect their core investment, they panic sell and dump their Indian bonds and stocks all at once. And this triggers a chain reaction in the currency market. When these foreign investors sell off their Indian asset, they are left holding large amount of cash but in Indian rupees. To take their wealth back home, they must convert those rupees back into US dollars. Suddenly, the market is completely flooded with rupees that nobody wants, while everyone is desperately trying to buy US dollars. That's how a gradual decline in the rupee can suddenly accelerate. And this is where the rupee's fall stops being an investor problem and becomes your problem, because a weaker rupee means every barrel of imported oil suddenly becomes more expensive in local currency terms. Fuel companies pass those higher costs through petrol and diesel prices. Higher fuel prices make transportation more expensive. Higher transportation costs makes everything more expensive, from vegetable and milk to cooking oil and household goods. And just like that, a financial decision made by a hedge fund manager sitting in New York quietly shows up on your grocery bill in India. So the question is, what are we doing about it? To stabilize the rupee, the RBI steps into the forex market. When international funds are panic selling rupee to grab dollars, RBI opens up its massive currency reserve. The RBI dumps billions of its own US dollar into the market. By doing this, they soak up all those unwanted rupees and stop the currency from crashing completely. But stabilizing the currency is incredibly expensive. To see how costly this can get, at one point, the RBI sold roughly $53 billion from its reserve to support the currency. The RBI also has another tool, hiking its main interest rate, also known as repo rate. When RBI raises this rate, borrowing becomes more expensive for both consumers and businesses, meaning the interest on your home loan, car loan and education loan shoots up. This reduces your disposable income, forcing you to spend less on non-essential goods and services, which helps cool down demand and bring inflation under control. This brings us back to the original puzzle. India is growing rapidly. New businesses are being created. Investments are rising. Yet, the rupee continues to weaken. That's because currencies don't reward GDP growth. They reward the balance between dollar entering a country and dollar leaving it. And as long as India spends more dollar than it earns, the rupee will remain under pressure no matter how strong India's GDP growth looks. If you like this video, please like, share and subscribe.